regulations in banking business. So those who are in the paid class, okay, it is useful for them also, and those who are watching on YouTube, for you also it's very useful. And kindly note, remember, join the paid classes ASAP, because here I'm taking the important definitions over here, but in the classes we have a lot of time. Okay, I'll be taking various numericals, various other theory parts also. So that's why join the paid classes, everyone. The numbers are given over here at the bottom. You are seeing this number, right? So call on that number and join it. Chalo, move on. So those who are in the paid class, kindly note, these are the important definitions which you should follow from module B. Okay, uncertainty. What is uncertainty? Under high uncertainty, banks tend to reduce loan growth, suffer more credit risk, and charge higher loan interest. What do you mean by this? Uncertainty means, like in COVID situation, there was a huge uncertainty, right? Because banks were very afraid whether the loans given will be repaid back or not. So that was the uncertain situation. So under such situations, what happens? Banks tend to reduce their loan growth. They tend to reduce their loans, right? Suffer more credit risk, because there is a huge credit risk, because there were huge NPAs during that COVID situation, and charge higher loan interest. So banks were charging higher, that is called as risk premium. Higher loan interest is called as risk premium. Okay, premium. So this is an important term under uncertainty. What happens to the banks during uncertainty period? Reduce the loan growth, everyone. Second, suffer more credit risk, higher credit risk, and higher rate of interest. Got it? Next is adverse selection. Now, what is adverse selection in this finance term? Is the difficulty to select and distinguish healthy companies with high credit rating from those that are riskier. Isn't it very important? And see here, the logic is simple, but if we don't understand it, then it becomes difficult, isn't it? So adverse selection is basically difficulty to select and distinguish healthy companies with high credit rating from those which are riskier. How will you select these? This you get it from the rating agencies nowadays. See here, you can solve this problem using the rating agencies. Like we have CIBIL over there, then we have CRISIL over there. All these companies give the ratings to various companies. Okay, these private rating companies give the ratings to these private players like Reliance or Tata or anyone. These are the big players, but there are also smaller companies. Ratings can be given to them also. So what is the difficulty to select a healthy company from the riskier company? It's that simple. Okay, so that's known as adverse selection. What is financial risk? Everyone, financial. Okay, you might be knowing this. Everyone knows the terms financial risk, but exactly what is required in the exam, that is the point of discussion, right? Otherwise, everyone knows what is financial risk, right? At a personal level, we always take the financial risk for investment in shares, for investment in mutual funds, right? But at a company level, at the CAIIB level, it is, what is it? See, financial risk is the possibility of losing the money on an investment or business venture. Simple and plain equation, right? Plain definition. Losing the money. Whenever I am losing the money, it's basically the risk. Some more common and distinct financial risks include credit risk, liquidity risk, and operational risk. So these are the common and distinct financial risks. So common risk means what here? I always face the problem of credit risk. What is this credit risk? Credit risk means if the bank gives a loan to somebody, whether that loan will be repaid or not. That is known as credit risk. Whether it will be repaid or not. Okay. Liquidity means what? If I give too many loans, suppose if the bank gives a higher percentage of loan as compared to its deposits, then it will be facing a difficulty in paying the normal rate of interest also. Okay. Or normal liquidity risk it will face for paying the common bills. So liquidity means whenever you give the loan, you should always see to it that the loan percentage, it has a maximum limit up to for the deposit purposes, deposit percentages. If I have given a deposit of rupees, if I am having a deposit of rupees 100, I must give the loan up to 70 rupees only. 70% is a good ratio for loans. Okay. So liquidity risk. And next one is operational risk. Operational means what? Operational risk relates to my operations. Means my employee errors or my system failure or my region failure, area failure. Area means what? There's a terrorist attack, there is a flood. So all these lead to operational risks. So financial risk also has these parts: credit, liquidity, and operational risk. Clear, simple. Risk adjusted return. Now tell me, what is risk adjusted return? Firstly, tell me risk adjusted means what? Okay, I'll ask you a question over here. Suppose if you are investing in FD of a nationalized bank or in a mutual fund, you are investing in a FD or in a mutual fund. Which of the investments will carry higher risk over here? Will the FD of the bank carry higher risk or will the mutual fund carry the higher risk? What do you say? Type fast in the comment section. Which one of the which one of the investment will carry higher risk? Investment in FD of the bank or investment in mutual fund? Obviously, isn't it mutual fund? So that's why the returns from those mutual funds are always called as risk adjusted returns. The risk adjusted returns measures the profits on the investment your investment has made relative to the amount of the risk the investment has represented throughout the given period of time. So what is the risk involved in this investment? Amount of risk, okay, relative to the amount of risk. That is important. Now, if I invest in bank FD, then the risk is zero. Nationalized bank FD, then the risk is zero. Okay. But if I invest in mutual fund, there is the risk involved in it. So this risk factor, I'll have to consider using my other derivative products. So this risk is to be mitigated using the derivative products. So those derivative products will require higher cost. See here, if you are buying I'll give you a simple example over here. Okay. Suppose if you are buying Reliance right now, Reliance share. Okay. You are buying a Reliance share at, let's say, 2500, expecting it to go up. Okay. But if it goes down, then to cover this downside potential or downside risk, what do? This risk is covered using put options. But this put options, whenever you buy this put option will carry the cost, because put option doesn't come for free. So this will carry the cost. So this is known as the risk, amount of risk, and it is known as the risk capital. Risk capital. How much risk capital I keep for my risk, to cover my risk. Okay. So this is to cover the downside. I'll buy a put, and this put will cost me something, and this will be known as my risk capital, which I keep it aside. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CAIIB from IIBF. Means IIBF gives various notifications regarding dates, times, change in the subjects. So all these are immediately given on the Officers Adda 24/7. Also, you get free YouTube series, right? Free YouTube series. Right now, what are you watching right now? Free YT series. So same free YT series, you get it for all the subjects. Okay, so subscribe to it, click on the bell icon right now. Okay. Risk adjusted return on capital, RAROC. What is RAROC? Have you heard this term RAROC? Type yes in the comment section. Have you heard this term before? RAROC. Type yes in the comment section or no. Whatever. Yes or no. So it is. Yes, I've seen many of them. Yes. Okay. So risk adjusted, we have heard the term, but we don't know the exact meaning of this. Risk adjusted return on capital means what? It is a risk adjusted measure of return on investment. Risk adjusted measure. Okay, what do you mean by risk adjusted measure? What do you mean by risk adjusted measure? Here, it does this by accounting for any expected losses and income generated from the capital, with the assumption that a riskier project should be accompanied by higher expected returns. So risk adjusted returns means what? See here, REROC. So same as this earlier, we have seen one earlier definition just now. Similar to this, higher the risk, higher I'll be expecting the return. So higher expected returns. So if I'm investing in higher riskier projects, then I should get a higher return. Only then I'll invest in the higher riskier projects. Otherwise, won't I invest in the FD, bank FD, isn't it? So it does this by accounting any expected losses. What all losses can occur whenever I invest in some riskier project, okay, and income generated by that capital. So whatever capital I've invested, what is the income generated from that? Whether it suits my this risk adjustment. Okay. Same example. Suppose if I am investing in FD or in mutual fund. So definitely I'll expect higher returns on the mutual funds, right? Whereas in FD I'll be expecting lower returns. Risk management process means what? Managing the impact of the risk by analyzing, forecasting and making predictions based on the historical trends. It also includes taking corrective measures to reduce the impact of the risk. So what do you mean by this? See here, managing the impact of the risk by analyzing, forecasting and making predictions based on the historical trends. Analyzing, forecasting and making the predictions. Okay. So all the three steps are involved in risk management process. First is analyzing, second is forecasting, third is making the predictions based on the historical trends. Okay. It also includes corrective measures to reduce the impact of the risk. Corrective measures. What do you mean by corrective measures over here? Corrective measures over here means, suppose as I gave you the earlier example, if I am buying a Reliance share, then I must buy a put. See here, this is called as long position. Long means, suppose if I buy a Reliance share, Reliance, okay, at 2500, expecting it to go up. So this is my long position. Whenever I am having a long position in stocks or commodities, then in the derivatives option or options market, I must have the reverse view. So in that market, I'll buy the put option. Put means what? If the market goes down, then the value of that put increases. Okay. So that's why whenever you are long on commodity, you must always buy put options to hedge that risk, and this is known as the hedging. Corrective measure means hedging. Okay. Maturity mismatch. It refers to the situation when company's short-term liabilities exceed its short-term assets. So short-term liabilities exceed short-term assets. What do you mean by this? We are talking of short-term only. Okay. Short-term liabilities exceed the short-term assets. Means suppose if my liabilities mean deposits. If my bank's deposits are much more than my assets or my loans, then I'll definitely face the problem of liquidity. Means I'll be facing the problem of this interest rate risk, because the interest going out will be higher as compared to the interest coming in, right? So maturity mismatches are visible on the company's balance sheet and can shed light on its liquidity. So immediately, if there is a maturity mismatch, it will be shown in the company's balance sheet. Why? Because the interest difference will immediately be displayed. Well, after all, you can't hide anything from the balance sheet. Okay. Maturity mismatches often signify a company's inefficient use of its asset, isn't it? Company's inefficient use. It means what? If I am having the loans, then I must use it properly. Properly means what? As a bank, I must see to it they are going to the basically to the productive assets, not to the NPA ones, right? Number one. Number two, also the durations of the loans and the deposits need to be matched. Duration. Okay, that's what the maturity says. Suppose if I am having a loan, or if I take a deposit of, let's say, deposit, okay, if I take a deposit of, let's say, 1 year, of let's say 1 lakh, okay, and I have to give a loan against this. So the loan against this will definitely not be more than 1 year. Loan should also be 1 year or less, right? So if I give a loan of 1 year, it's the best. So 1 year, it should be, the maturity should match of deposit and loans, okay. Market value of the equity. It is the total rupee value of the company's equity and is known as the market capitalization. What do you mean by this capitalization? Understand this word. See this. It means that if Reliance share, let's take Reliance only. I take Reliance share because it's a known share to everyone, isn't it? So now, suppose if I take a Reliance share and this Reliance share now, let's say, is priced at 2500. Okay, let's say 2500. And now what happens? This Reliance has issued, let's say, I'm giving an example, 1 lakh shares in the market. Number of shares is 1 lakh. So what is its market capitalization? So the market capitalization over here will be 2500 into 1 lakh. So 2500 into 1 lakh. So those many rupees, okay, will be the market capitalization of Reliance. Okay, so that is known as the market value of the equity or market capitalization. Total rupee value of the company's equity. This is the total rupee value of the company's equity. The measure of company's value is calculated by multiplying the current stock price by the total number of outstanding shares. See this, we have done the same thing. Current market price into total number of the outstanding shares. How many shares have been issued in the market? Okay, that is known as outstanding shares. Got it? So Reliance shares over here, the market capitalization will be, okay, give me the answer everyone. 2500 into 1 lakh. What is the answer? 1 lakh means how much will it be? Yeah, 2 crores. Then, yeah, 25 crores. Yeah, it will be around 25 crores, right? 25 CR. That will be the answer roughly, right? Yeah. Coming back, chalo. Next one. Before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever we need for clearing JIB and CIB, we'll get it over here. So download it right now and start studying. Okay. Next one. Downside potential. It is the estimation of securities of a security's potential loss in the value if the market conditions precipitate a decline in the security's price. Means what? Here, potential loss, keep it very simple. Potential loss due to decline in price of the security. Means, for example, we have studied this in our ABM also, okay, or in our JIV also. If the price of the bond, let's say, let me take Reliance only, okay, Reliance share. If I brought it at 2500 and if tomorrow the price of Reliance goes down to let's say 2000. So what is this happening? This is the downside potential. Securities potential loss due to the decline in the securities price. Okay. Depending on the measures used, downside risk or explains a worst case scenario for an investment and indicates how much the investor stands to lose. So worst case scenario means what? What is the lowest level which this stock can go down, or what is the lowest level at which this bond can go down? Okay. So worst case scenario over here is always taken into account by any company whenever you're doing a conservative investment. Okay. Indicates how much the investor stands to lose, how much this investor will lose if this downside potential means if the Reliance share goes down. Okay. Next is CCIL. The Clearing Corporation of India was set up in April 2001 to provide a guaranteed clearing and settlement functions for the transactions in money, government securities, foreign exchange and derivative market. Remember, here it's not talking of stock market. So provide guaranteed clearing. Guaranteed means what? What do you mean by this guaranteed? Isn't anything guaranteed then? See this guaranteed clearing over here means it is called a settlement risk that is cleared. Okay. Guaranteed over here means settlement risk is nullified over here. What is settlement risk? Settlement risk means, let me give you an example. If you sell, let's say, shares, okay, you sell, let's say, shares to anyone. Shares. Okay. So this other person, Mr. X, Mr. X should give you rupees, right? Rupees. Because you are giving the shares, Mr. X will give the rupees. So what do you mean by settlement risk? If you give the shares and Mr. X does not give you rupees, then what? Then this is known as settlement risk. So CCIL guarantees this part. Provides a guaranteed clearing and settlement function for transactions in money, government securities, forex, and derivatives market, right? So CCIL is okay. Tell me one more thing. This shares example which I gave you, does it take care? Does CCIL take care of the shares over here? Does CCIL take care of the risk of the shares, settlement risk of the shares? No. Then who takes care of the settlement risk of the shares which you buy and sell? Type fast in the comment section. Who takes care of the settlement risk of the shares which you buy and sell? Yeah, who takes care? Because here CCIL is very clear. CCIL is money, government securities, foreign exchange, and derivatives market. 4 clear. Does it say anything about shares? No. So who talks about shares then? Correct. NSE and BSE. NSE and BSE, these stock exchanges, they take care of the settlement risk of the shares. And for others, everything else, there is CCI. Okay? Yeah. Like that, there are some things which money can't buy. For everything else, there is MasterCard. That was ad. Remember anyone? Now gone, isn't it? MasterCard was having an ad few years back that there are some things which money can buy, and for everything else there is MasterCard. Similarly over here, only share settlement risk is taken by NSE and BSE. For everything else there is CCI. Okay. What is EWRM or EWRA? What do you mean by this? Enterprise wide risk measurement or risk assessment. Enterprise wise means what? Enterprise wide means total related to enterprise. Complete company wise. EWRA or M you can call it, assesses the risk of anti-money laundering, counter-terrorist financing, means AML and CTF, and sanctions, in addition to the counter-proliferation financing and anti-bribery and corruption. Now these are important terms which may come to you in exam. Okay, so money laundering, AML, counter-terrorist financing, okay, means terrorist financing. Okay, then second is counter proliferation financing. Okay, this is again a type of this AML only. Anti-bribery and corruption. Anti-bribery and corruption. So bribery related and corruption related. So this, even bribery and corruption is part of this enterprise-wise risk, because after all it's a risk, isn't it? Thus these are most inclusive elements of EWRA. So these are all the inclusive elements of EWRA or EWRM, right? Remember, whenever you are talking of enterprise-wide risk measurement, it means you are talking of the whole company, not of a specific section. Okay? Now, before everyone, I would suggest kindly, I told you just now, join the Adda 24/7 Officers Adda 24/7 channel. How to join it? Suppose if you have to join on this Telegram, okay, scan this blue QR code. Pause this video and scan this blue QR code. If you have to join this YouTube channel, scan this right side QR code, this one, okay, this one. If you have to join the Instagram channel, so scan this blue QR code, this one, okay, and you can join it. See, there are many benefits available for this, okay. So definitely I would suggest join. Everyone should join this because this is very useful to you. Remember, we give various questions, various recordings plus tests are available on these channels for free also. It's not only paid. Many of them are free also. Okay. So that was the session for you. Now before going, let me just urge you to join this Sankalpa batch for June 2024. All the 4 subjects are covered. Numerical, subjective questions, case studies are covered. And you can join the Mahapack as well. In Mahapack, you get multiple batches. Plus you get ebooks, tests, everything you get. Now how to join this? Let me show you. Go to Adda 24/7, say this. I'll always suggest you to go through the app. In the app you get coin systems, and this coin systems will give you around 1% extra. Okay, so that's why go through the coin systems and go through the app. Say this. Go to JIB and CIB, then click on this JIB and CIB. Click on June 24. Okay, you'll see the batches. Look at this batch, Sankalpa batch. You will get ebooks, tests, online live classes, expert faculties, interactive classes, recorded videos, limited size batches. You can read this, go through it. Details are given, complete highlights are given, and presently 80% off is going on. So join it. How to join it? Click on buy now. 80% prep 80 code is already applied. Then click on continue. Fill in your details, full name, phone number, email, and that's it. Similarly, you can join the Mahapacks also. In Mahapacks, as I told you, in Mahapacks you get multiple batches. Let me show you that also. Say this. Click on June 24 again. Then click on CAIIB Mahapack. You get multiple batches over here. Now you are having two offers over here. One is double validity and 80% off. So double validity means you buy for 6 months, you get for 12 months. You buy for 12 months, you get for 24 months. And at what fees? 80% off. So join it ASAP. Okay. Again, same way. Click on buy now and then fill in your details. Ebooks are available, tests are available. Okay. So join fast. Don't consider it that the time is, you have a lot of time for June series. No.